Understanding Level 3 assets, definition, valuation, and regulatory framework. In the realm of finance and accounting, asset valuation is a crucial process that enables stakeholders to ascertain the worth of various financial assets and liabilities. Among the classifications established, Level 3 assets stand out due to their complexity and challenges in valuation. This article will provide a comprehensive overview of Level 3 assets, including their definition, examples, valuation methods, regulatory frameworks, and special considerations investors should be aware of. What are Level 3 assets? Level 3 assets are classified as financial assets and liabilities that are considered the most illiquid and hardest to value. Unlike Level 1 and Level 2 assets, which have observable market prices, Level 3 assets often lack active market trading, making it difficult to ascertain their fair value accurately. The valuation of these assets relies heavily on estimates, mathematical models, and subjective assumptions rather than easily observable values. Key characteristics. Liquidity. Level 3 assets are illiquid, meaning they cannot be quickly recovered into cash without significant discounts or losses. Valuation difficulty. They rely on internal models, assumptions, and possibly the judgment of management to estimate their value. Market activity. These assets are not traded frequently, further complicating their pricing. Notable examples. Mortgage-backed securities, MBS securities backed by a pool of mortgages, subject to credit default risk. Private equity shares, investments in private companies that may not have a readily discernible market value. Complex derivatives, financial instruments whose value derives from the performance of underlying assets, often involving uncertain risks. Distressed debt, bonds or loans from companies that are in default or near bankrupt, often illiquid and hard to evaluate. Foreign stocks, stocks of international companies that may not be actively traded in the investor's home market. The valuation process, mark-to-model. Valuing Level 3 assets often involves a process known as mark-to-model. This approach uses various valuation techniques, incorporating factors such as discounted cash flow analysis, estimating the present value of expected future cash flows. Comparative analysis, using valuation multiples derived from similar companies or assets, although this can be dicey due to lack of comparables. Statistical models, applying advanced mathematical models that factor in market volatility, interest rates, and other economic variables. Mark-to-model can introduce significant subjectivity, as different analysts may arrive at varying values based on their assumptions and methodologies. Regulatory framework. In 2006, the Financial Accounting Standards Board, FASB, issued FASB 157, now Topic 820, which established a framework for measuring fair value and classified assets into 3 levels based on the reliability of inputs used for valuation. Levels of asset classification. 1. Level 1, assets valued using observable market prices, such as stocks and government bonds. 2. Level 2, assets valued using models based on observable inputs but not actively traded, such as interest rate swaps. 3. Level 3, assets employing unobservable inputs and models, as described above. Revisions and enhancements. Following the financial crisis of 2007, discussions surrounding Level 3 assets intensified due to their role in exacerbating the crisis. New regulations were introduced, enhancing disclosure requirements. Topic 820 updates. Companies must now describe how various valuation techniques were applied and reconciled for Level 3 assets. Quantitative disclosures. Entities must disclose the range and weighted average of significant unobservable inputs, which are crucial for assessing potential valuation risks. In 2018, further updates introduced expectations regarding disclosures about measurement uncertainties and the effects of volatility in unobservable inputs. Special considerations for investors. When evaluating Level 3 assets, investors should approach them with caution. Subjectivity in valuation. The subjective nature of valuation can lead to discrepancies, and thus investors should not take the reported values at face value. Margin of safety. Investors may opt to apply a margin of safety to account for potential misvaluations. Industry context. While Level 3 assets are typically a smaller part of a firm's portfolio, they can constitute a significant portion in sectors like investment banking and complex financial markets. The bottom line. Level 3 assets represent a challenging and often misunderstood area of financial valuation. The absence of observable prices and the need for subjective judgment in their valuation make them risky propositions for investors. However, their existence is crucial in various financial markets, pushing companies toward enhanced transparency and accountability. Understanding Level 3 assets and the broader context in which they operate is essential for investors seeking to navigate the complexities of financial analysis and make informed decisions.